Good morning, everybody. It's 10 o'clock, and looks like everybody's here. We'll call the meeting to order. Item 2 on the agenda is approve the minutes of the meeting of September 11th, 2014. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. And item 3 is a presentation from K2. And Jake, you want to say anything before we introduce?
This morning we have in Dan Ellsbury from K2. K2 is your long-short equity manager. You have a 10% allocation to hedged equity as part of the overall portfolio, but also within your equity portfolio, designed to provide basically insurance and lower the risk of the equity portfolio while still participating in equity markets. And this is just a regular update to have a minute. I'll turn it over to Dan.
Morning, sir.
Good morning, everybody. How are you?
Fine. Good. Oh, it looks pretty good, I think. Yeah.
Can you do that? Can I steal one of those?
There you go. Dan's got about 30 minutes, and however you want to do it, Q&A at the end, or while you're talking, whatever suits you, sir.
I think while I'm talking is fine, if you don't mind. My name is Dan Ellsbury, and I'm Senior Managing Director of K2. Certainly appreciate the opportunity to be here today. It's been a while since we've been back, but thanks for having us, number one. But more importantly, we're coming up on our 10-year anniversary. You guys invested in K2 January of 2005, and so I want to thank you very much for the confidence that you've shown in K2. So over the past couple of years, I'm sure Jason's kept you up to speed in terms of what's been happening at K2. Certainly, the most notable is the Franklin Templeton merger. We like to call it a merger. They call it an acquisition. I guess it depends on what part of the fence you're on. But, so basically what happened is Franklin was looking for a kind of an alternatives component of their business. If you look at their business, they have $900 billion. We have about 10, so we think that's fairly equal, but certainly made an impression on them. But, what they were looking for was to really build out their alternatives platform. And what they saw in K2 was a real cornerstone to do that. If you look at K2's business, we're managing about $10 billion, and we have investments with over 100 managers across the globe, across a full spectrum of hedge fund strategies. So what they saw is a very organized and a very in-depth hedge fund component to add to their business, very similar to what you've done. They were seeing clients add to alternative investments. So they were looking for a number of alternative pieces to add to their portfolio, so they could look at hedged equity, they can look at real estate, private equity, and a whole host of other alternative aspects. So they really looked at K2 as the cornerstone for that. And if you think about it, it's been a great fit. One of the things, Franklin has a history of acquiring asset managers, but the key component of that is they leave the investment engine alone. And so a lot of times when these things happen, they're sort of what's advertised and then reality. Happy to say 2 years into the deal, it's exactly as advertised. You look at where we've been able to leverage some of Franklin's resources, and certainly on the client service, sales, back office, IT, it's been a huge plus for K2. And yet on the investment side, they've kept the investment engine alone. So Brooks Ritchie, Rob Christian, Dave Saunders, Doug Douglas, they're the core of K2's investment committee, if you will. They get to leverage Franklin Templeton's global reach, global performance metrics, global research, and global portfolio construction. So if you think about, they have 700 investment professionals we are now able to access in terms of just having an understanding what's happening in the markets, what's happening over in Asia, what's happening in Europe, Africa, South America. So it gives us more information to be able to utilize in terms of portfolio construction. And to add to that, just as an aside and something just to remind you of, I know you're familiar with this, But if we have 110 managers that we think are some of the best asset managers out there, they've started hedge funds, they're able to get through K2's manager selections process, which is quite complicated. So we're getting information from them on a monthly basis. So if you add the fact that we're getting these 100 managers telling us what their feel is, what's happening in the markets, and in addition to that, being able to leverage Franklin Templeton's expertise globally, it really makes us an information hub. So really, this is a component from our perspective where 2 + 2 really does equal 5. While K2's investment engine's been able to stay intact and stay the same, we're able to leverage a huge amount of Franklin Templeton resources. So I think overall that the merger has gone quite well. We've integrated every aspect that we think makes sense and yet kept the engine alone. So I think that's an important part. And I'm happy to address any questions on Franklin Templeton before we move on to the portfolio. Terrific, thank you. So let's go to performance. Let's look at page 5. I'm not going to go through every page of this. I'd much rather have a conversation than just go through these things page by page. So let's look at the 10 years since we've been working together. The bottom part of that will tell the story. The annualized return over that time frame, just call it 4.5, with a standard deviation of 6. The benchmark is the HFRI Fund-to-Fund Strategic Complex. We beat the benchmark by about 100 basis points annually. With
Can you just explain what that Fund-to-Fund Strategic is? What it includes?
Yeah, so the Fund-to-Fund Strategic Index is one that these are very broad, general hedge fund benchmarks. And there's a number of benchmarks that we use, and this one's selected specifically, for this particular fund. It's a little bit more equity focused, and so being that this is a long-short mandate, ACG and K2 thought this was the appropriate benchmark for that. Jason, do you want to add anything to that?
It's an equity-oriented
Right.
funds index. In addition, we also compare the strategy from a risk standpoint to the long-only indices as well.
Well, and exactly to that point, if you look at the S&P over the exact same time frame, the performance for the S&P was about 770 with a standard deviation of 17. So we picked up about 70% of the performance of the S&P with a third of the volatility. Now, I would argue there's 2 years in here that we were disappointed with. Well, actually one. 2008, we were down 14. We did relatively well when you look at the equity markets down 30 to 40. But we were disappointed. We thought we had pulled the beta back. We have the ability to tactically allocate within the fund. And going into the summer of 2008, we thought we had pulled the beta and exposures back appropriately. But when we got into the fourth quarter of 2008, it was a bit of a challenge, I think, for everybody. And we performed. We were down 14. But the one that stands out to me that we underperformed was in 2011, down 6. S&P was up 2 that year. It was a challenging year, but that's why you hire us, to do a good job in challenging years. I think we underperformed in 11. At the end of 11, we made some changes that I think have shown out, and borne out quite well. This is a long-short equity fund, and typically we'll have a number of different subcomponents of the fund. We have generalists and we have managers that tend to be market neutral. We looked at the space during that time frame, and if you remember, we were in a pretty good bull market. S&P's up 200%, since 2009. So what we did is we went in and we reduced the number of generalist managers who cover multiple sectors, and we also reduced the market neutral managers. And we selected more niche-focused managers, activists, a little bit dicey for some, but we can talk about that in a second, event-driven managers, sector-specific managers, and geographic-specific managers. And if you look at 2012, 2013, and so far this year, I think we've done quite well, certainly versus our peers and versus the benchmarks. So I think those 2 years were challenging in the 10 years that we've been together. But I think we've done a good job positioning the portfolio, and certainly the last, from 2012, 13, and 14, I think they've done a good job. If you look at it just on the more recent basis, you can turn the page to page 6, and we look at sort of how we've done quarter by quarter. Last year was a terrific year from our perspective. Granted, the S&P was up 32. We were up 17, benchmark up 10.5. This year, year-to-date, 376 versus a 285. September was a challenging month. We are going to be down in September. I don't have the final numbers yet, but it's going to be close between 75 basis points and 1. It was a pretty challenging month. I think you saw that in most of the equities that you have. But in terms of performance, I think that the portfolio managers have done a very nice job. So again, it's the theme that I mentioned about more niche managers. If you look at the portfolio drivers, and it's on the next couple of pages, certainly page, I think 7 will give you a highlight. And you don't have to read this. I'll give you the bullet points. You know, the activist managers have done a good job. Activists are much more accepted today than they were even 5, 6, 10 years ago. Carl Icahn used to be a four-letter word to a lot of people, and sort of what he was doing with corporations and coming in and really blackmailing companies. And if you look at the activists today, it's actually quite different. They're much more accepted. They're working within the boards as opposed to the boards. They're actually getting involved in the companies. One of the terms that you hear thrown around a lot is unlocking shareholder value. Now, David Einhorn did that with Apple when you remember all the rigmarole over Apple and how much cash they had. And so he really made an impact and had them really take a look at that. More recently, Carl Icahn did the same thing with, HP. So it's interesting to see they are making a difference. And if you look at it purely from an investment standpoint, over 75% of the investments that these guys and women go into end up making more than the market. So they do have an effect. They do a good job. The downside to that, and we're seeing that in September, we saw that again in March and April of this year, is they tend to be higher beta, high exposures, because they tend to be more long. They're longer than the typical hedge fund manager, right? Because they're typically going after a company. They're buying it to hold it and to make a difference. And so there's not as much hedging typically in an activist portfolio. They tend to be a little bit more exposed to the markets. So when the markets turn down, they tend to get hit a little bit. But on the other side of that, and if you look at May and June, and again in August, they also bounce back much quicker than a typical manager. So we like activist space a lot. Event-driven is another category that we like, and you guys are seeing this as much as we are. You come in Monday mornings and you see the latest merger that popped up over the weekend. We call it Merger Monday. It just seems like that the money that's been on the sidelines for so many years is actually going into effect, and there's a lot of companies that are utilizing that cash to go out and really invest in other companies, trying to make strategic acquisitions. So on the event-driven managers, these are managers who are going into potential mergers and acquisitions, going into special situations within companies. So there's some real opportunity there. And we think that the mergers are going to continue this could be a record year. And we think that it'll continue in 2015 to some degree as well. So we like that opportunity. On the sector side, there's been a couple of sectors that we've been invested in now for a couple of years, and they've done a great job for your portfolio. Technology and healthcare are the two main themes. Technology is pretty easy. I mean, everybody knows that the latest iPhone 6 is bendable or not. It's going to make Apple a lot of money. So there's a lot of CapEx that's happening on the technology side as well from companies who are really spending money on technology, and we're seeing that in productivity, we're seeing that in profitability on the corporation. So that's making an impact. Again, the downside to that is that's a fairly volatile sector, so when the market turns around, it will trade off, and that's what we saw again in March and April and again in July. That when that trades off, it helps you on the upside, but it's going to hurt you a little bit on the downside. But we think that that comes back strong. And then the other one is healthcare. Most of us here are certainly in the baby boomer stage, and we're the ones driving that market. So ACA made a big difference. We started investing heavily in healthcare once that got passed. It's just a huge wave that's happening, and we think that that continues. We're also utilizing activists in the healthcare arena too. So these are activists that specialize in healthcare companies. So it's kind of for us, that's a double plus. We think healthcare going forward, the biotech, the pharmas are going to be real opportunities going forward in the equity markets. We think the equity markets are going to be more selective. There's certainly, we've seen that the last couple of days, there's a lot more volatility in the markets, and that's not going to go away. There were a lot of folks coming into this year thinking that equity markets could perhaps stall or trade off. It hasn't happened yet, but I would argue we're certainly looking at a potential stall here going into year end. And in an election year, that's a little bit interesting, but it's been challenging. So we think the volatility picks up, so you want to be very specific on what your bets are. So healthcare, again, is another component that we like a lot. On the global front, believe it or not, we like Europe. And the reason we like Europe is we think that there's such dispersion in Europe between what's happening over there, the periphery of Europe, if you look at Spain, Ireland, Italy, Greece, Portugal, and then there's Germany and others that really have exports. So if you look at the difference between those that can export versus those that are just dealing in the domestic arena, we think that dispersion within those two different types of companies offers some opportunity. And we're just actually added another manager to the fund to go after some of the European exposure. And then lastly, Asia, again, very selective. We're watching China very cautiously. We think that there's opportunity there, but it's selective. So we're not very, our exposures to China aren't very long, if you will. We don't have a lot of long bets in China, but we're watching, we're very selective again on specific entities within China. The China internet companies, you can't ignore them. They're huge. And they're certainly dealing with the U.S. a lot more these days. We're seeing with Alibaba and Tencent and a number of other issues that have been in your portfolio and have done quite well. So overall, I think that the portfolio is very well positioned. This is the year, I haven't seen a year like this in K2, I've been there 10 years, where we only have 2 manager changes this year. They're adds, one to Europe, one to Asia. And again, they're cautious managers, right? We're I'd say cautious on the equity markets overall. It's very interesting when you look at, kind of going into this year, and I think it's going to be more as we go into next year, that if you look at, post-crisis, we had a huge run-up in the bond market, followed by a huge run-up in the equity market. And most of the clients and consultants we talk to are really almost looking at a bit of a reset here. So fixed income is going to be challenging going forward, I think. There's nobody that will doubt that. Your rates at some point have to rise. I'd hate to put a date on that. But on the equity side, we've had a 200% run-up. I'm thinking that one be a little more selective here. So it's interesting that if you think of the 21 managers in your portfolio, when we talk to them on a monthly basis, they're telling us what they're thinking about the markets, how they're positioning their portfolios, what they're doing in terms of risk and exposures. So none of them know what the other one is doing. So it's up to us to kind of aggregate up all this information. And again, I know you remember, but K2 insists on transparency with every single manager we invest with. There's no manager out there that's that good that we're going to change our process on. The reason is, as we look at a manager's portfolio, position by position, it's almost as if we have the DNA of every manager. So if we look at the positions over 100 different market factors, and let's say the issues Greek sovereign debt or commodities or a rising rate environment, we can look at every position and see how that manager's correlation or beta is to that particular move in the market. So when you take those 21 managers and put them together, now I have a real picture of exactly how this portfolio's DNA looks. And if I'm concerned about rising rates or if I'm concerned about commodities, I can look and see exactly what my exposure is in any one of those 100 factors at any point in time. And then it's up to K2 to make the decision. If all of a sudden the managers are saying, look, I like energy, so therefore he's getting commodity exposure, and one of the activists says, okay, I'm going after Halliburton, I'm going after Schlumberger, he has commodity exposure. So inadvertently, we start to see the rise in our commodity exposures, and if we feel that we're a little bit hesitant on commodities here, we can add to a manager who's negatively correlated to that move. So they're all different idiosyncratic movements within the portfolio. But having the holdings allows us to really understand what those exposures are. And from our perspective, from the portfolio construction side, we can then make changes. Because what we're not going to do, if Jason's my long-short manager and he's going after energy, I'm not going to call Jason and say, you know what, we're not really big on energy here. We think you should pull your exposures back. Jason's strength is in energy. That's what he does well. That's why we hired him. I don't want to change what he does, but I want to understand what he does, so when I put the portfolio together, hopefully we're doing it thoughtfully, to be able to really get the most bang for the buck on allocating to managers. So looking forward into 2015, I think we talked about that already, but cautiousness, I think, is a pretty good word here going into the equity markets, and selective. So again, it's the niche strategies. We still like activists. Activists are going to continue to generate returns. They're going to continue to get assets. Event-driven, we think, continues. We like long-short equity. If you look at what economy is moving out there in the world today, we're kind of it. And so as there's a flight to quality, it comes to the U.S., we're seeing the dollar rise. We're seeing the yen and the euro come down, as is the pound. So there's a lot of interest in U.S. equities. And if rates do start picking up, it's going to be pretty challenging on the fixed income side, so where do you go? Well, maybe very cautiously you add a little bit more to equities, and ACG is a terrific firm, and they'll lead you in the right direction. So we think that there's a great place for hedged equity here. We're having a lot of conversations when clients are looking, and you guys probably have done the same thing, where you look at your equity allocation and you're going, geez, I don't want a repeat of 08 here. I can't lose 25%. So they're taking allocations from long-only equities, putting them into long-short managers to protect on the downside. You are not going to outperform equity markets. Hedge funds are not designed to be up 32%. They're just not. Contrary to everybody's belief that hedge funds are this wild and crazy group of cowboys out there knocking down 30% returns, there are managers like that. You won't see those managers in a K2 portfolio. So it's important to understand how you're building the portfolio, who you're building it with, do it thoughtfully, and put them together in a reasonable fashion. So with that, I'll stop to take questions.
Any board members have any questions? Jason, you have something?
I have a few more macro questions. So can you talk about looking at long-short equity? Can you quantify flows into your funds over the last year into long-short equity?
Sure. So the long-short equity is still the largest component of the $10 billion that we have allocated. Probably 45% of our $10 billion is invested in long-short managers. Now, in terms of the flows into this particular fund, it stayed pretty neutral all year. There was no major changes. In terms of we're getting a lot of different style mandates, custom mandates, and other equity mandates that the clients want specific funds built for them for specific reasons. There's still a large amount of flows into the equity long-short space. So again, we're about 45% of our $10 billion is in long-short managers. It's so far and away our largest part of the allocations. If you look at, there's a little bit of, there could be certainly a discussion on activists and event-driven. Are they equity managers? Are they credit managers? And it really depends. We bucket them, what we think is appropriate depending upon how the manager's portfolio is positioned. But, K2 is still the largest allocation to long-short managers.
A couple of other things. One is on fees. What has been your ability within this strategy to push down underlying manager fees and costs? And then the second, which is the elephant in the room, would you just comment on Calvert?
Sure, absolutely. Thought I was going to get away with that one, but not quite. Fees are just it's a constant concern. Any manager we go into, and again, just to remind you all, we have a 5-team, 5-step process on our managers. Every team has to sign off on a manager before we even get to the point where we can negotiate fees. So with that said, we're constantly trying to get manager fees down as low as we possibly can. Typically, a manager's 2% management fee and 20% incentive fees. So coming out of 08, there was this huge push to be able to knock these managers' fees down. What happened is it's easier to knock managers' fees down if they're not very good. If the manager is putting up good numbers, there's people lined up out the door to pay them 2 and 20. And you're getting net what you wanted to go in for. So there's a real wrestling match going on with fees. Typically our manager, we can get them down to 1.5 and 17 and 18 is kind of the overall average fees. So the other piece of that though is we will also negotiate capacity rights. So if a manager is really good, and you knock their fees down a lot, the odds are when they open up a new fund or open up a new share class, are you going to be the first one they call? Maybe, maybe not. So it's a little bit of a balancing act. We're certainly trying to do the best we can, leverage the $10 billion we have to negotiate the best fees we possibly can for our clients. At the same time, we want the best possible managers we can get in the portfolio. So CalPERS has been an interesting component. Certainly when the news came out, there was a lot of buzz, and if you look at CalPERS' portfolio, this was a $4 billion hedge fund portfolio on a $300 billion fund. So one would argue, if you're not going to invest something that's going to move the needle, why are you bothering to do it? And the number was $135 million in fees, and that's a big number. But if you read through the stories, they weren't concerned. They weren't. The issue wasn't about performance; it was about complexity and the fees that they paid. So there was also a real fight on the board. Joe Deere versus another couple of board members. Joe was pushing to keep the hedge funds. Unfortunately, he passed away. The other group sort of took over, and they weren't enamored with hedge funds and decided to cut the program. There's probably a whole host of different reasons within that I have no knowledge of. But for public funds, I certainly understand the issue surrounding fees paid to managers. I absolutely get that. It's been very interesting. We certainly haven't seen anything negative to that. PIMCO certainly helped that out. I mean, that was all of a sudden the huge story. But it's a real story, and it's one that we need to deal with, is fees. Again, it's the challenge between, is a manager that good that he deserves that number? That's for the market to decide. If they continue to get assets, if they continue to perform and continue to get the net numbers that the clients are looking for, I think that those managers will continue to get assets. And if you look at hedge funds generally, if you look at over the last 20 years, hedge funds have gone from $38 billion to $2.6 trillion with a T. And over the next 3 to 5 years, there's a number of reports out there that suggest that that could double. It's not going to go anywhere. But the fees will always be an issue. And I think at some point, we will be able to get the fees down. Certainly from our perspective, we're doing the best we can to negotiate the best terms and conditions. So it's about capacity, it's about transparency, it's about lockups, and it's about fees. It's all of those components. So I think we need to look at that in the totality of it.
So you don't see any resulting leverage with the merger with Franklin?
In terms of the manager fees? Well, if you think about it, Franklin has $910 billion. They have about $200 billion in institutional assets, none of which were in hedge funds. So, we're certainly, we have a huge partner now, and it's extraordinarily well respected. We're getting in and talking to people that we've never had the opportunity to talk to before, as you can imagine. As we keep moving the needle and as we keep building out the alternative platform at Franklin Templeton, I think we will get more leverage. But in terms of Franklin's kind of moving assets into the hedge fund space, that's really driven by K2 at this point, and we are the hedge fund engine within Franklin Templeton. So I think it's largely going to be based on our assets right now and the money we're putting to work with managers. But Franklin there's been a big push from Franklin for us to build a 40 Act mutual fund, which we did. So they have a retail component from the business that they're focused on. That will help us. And as that, I think that's going to be the best way for us to get assets into hedge funds, is really through that 40 Act fund. And that will just increase the leverage we'll be able to use at some point, but that's probably a year or so away.
Any other questions any board members have? Got anything else, sir?
Well, again, I just want to thank you for the opportunity to be here and to work with you for the last 10 years. I'm very excited about where we are, the partnership that we have with Franklin Templeton. I think the resources that we now have at our disposal that can help you in any number of ways now, really across the portfolio, I think it's going to be a huge benefit to our clients. And I think that we're well positioned. I would argue over the next 3 to 5 years is a very good environment for hedge funds. It's going to be challenging on the fixed income side, except for ACG, who's going to do such a good job for you, and it'll be a little bit challenging on the equity side. But I think hedge funds are really, this is the type of market that hedge funds are for, to protect on the downside when things happen. So I certainly hope we're able to keep our relationship going. If there's anything we can do to help, we're certainly happy to. But again, thanks again for your time today. Appreciate being here.
Thank you, Dan.
Thanks.
Okay, next up is item 4, ratify approval. There's 2 items. One's the payroll, and the other one is to make, secretary to make the necessary changes for 2 cases, or 3 cases on the docket. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 5 is approve the claims docket. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 6 is approve the following applications for service retirement, and there are 6 of them. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 7 is to receive a report of death and authorize payment of the $5,000 and approve the continuation of the pension to the spouse. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 8 is receive report of death and authorize the payment of $5,000 and authorize the secretary to make the necessary changes. And unfortunately, there's 7. That's the first time we've ever had that many that I can recall. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 9 is to approve the following applications for vested rights. Motion been made. Are there a second? Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 10 is discuss or authorize. They are 3 items. Why don't we just take them individually? The first one is Statement of Investment Policies, Objectives, and Guidelines. Jason, you want to talk about that one?
Yes. So I think Renee sent out in advance the full version, but I just handed out a skinny down version that just has the changes.
Okay.
And some of these are just to get the policy in line with some of the decisions you've already made. On the back of the first page of what I handed out, which is page 5 of the policy, if you look down at the bottom, you'll see a change to the policy index, adding in the middle of the page performance objectives. This is for the total fund. So now that you've implemented the commodities, we're adding 5% commodities to your policy index from a tracking standpoint, and we've taken that from fixed income, from the Barclays Ag, reduced that from 35 to 30. Ultimately, and you don't have this, the full asset allocation, but your target to fixed income is 25% overall. We're just not there yet because real estate continues to be underweight because the opportunistic and core real estate is still about 3% underweight, and that's going to take some time to get there. So from a measurement standpoint, we're just trying to keep the policy index as close to how you're actually implemented. So that's a change. The other 2 are the addition of guidelines, one for Brandywine, and Randy pointed this out to me. I didn't catch this, but the section that's titled Opportunistic Fixed Income Manager Guidelines, we really should be calling that Global Bond Manager Guidelines. Again, in your asset allocation targets, you have a 25% target to fixed income, but then that's broken down into subcategories, and those subcategories are core bonds 5%, core plus bonds 7.5%, global bonds 7.5%, and then low volatility hedge funds 5%. So the section is to tie to the global bonds, which is the Brandywine strategy.
So we need to make the necessary...
So the changes would be in the title, the heading, instead of saying opportunistic fixed income,
global
it
bonds.
should say global bond manager guidelines.
Okay.
And then down at the bottom, under performance expectations,
Right.
it should say the global bond portfolio should outperform and then in replacement of relevant opportunistic benchmark, it should say Citigroup World Government Bond Index over a market cycle. Because that's the benchmark that we use for Brandywine. Everything else is the same because it's a commingled fund that you're using. We just describe what it is, and the portfolio should be consistent with those commingled fund guidelines. So I apologize for that. Good catch by Trustee Thurman. And then the last one is just adding commodity guidelines. Again, you're utilizing a commingled fund, but we do want to have guidelines in there. They're primarily performance-related guidelines, and just say how we're measuring them, because you've now implemented the Gresham TAP fund as the 5% commodity.
Is that it, sir?
That's it.
Okay. We need to entertain a motion with the changes that have been made. Motion been made. Are there a second? Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Okay. Item B is the agreement between the City of Oklahoma City to provide professional and non-professional service, office rental to the employee retirement system. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item C is the administrative service agreement between the Oklahoma City Employee Retirement System for administrating of the 457 deferred comp plans. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Okay. Item 11 is investment consultant report. Jason, you're back up, sir.
Okay, a couple things this morning. One, the monthly report. Just, I think it's certainly timely that you have your long-short equity manager in this month to just put in perspective after what we've seen in the last quarter, which has been a pretty rough quarter in the capital markets, particularly September. If we look at returns across asset classes, everything, including bonds, were negative in the month of September. Certainly a number of global geopolitical events that are kind of shocking markets a little bit, concerns about probably more tepid or slowing growth is just pulling things back, and the fact that we've had 5 years of very strong equity market returns, and sometimes it's just time to pull back a little bit. But as we think about, just tying on to what Dan and his comments about K2, I think it's important to keep in mind the discussions that were had 10 years ago as to what the purpose of long-short equity is. It's funny, we try very hard to talk about this asset class as long-short or hedged equity and not get into the discussion about hedge funds, which you're starting to see the conversation getting more back to that topic of hedge funds. But the purpose of this 10% allocation in your portfolio is to have equity exposure, but to allow equity managers to invest in ideas that they think, in companies or securities that they think are going to appreciate, but also take advantage of their research on companies that they think are going to go down and be able to profit on shorts, and also be able to hedge exposure to overall market directions in general. And so without holding cash or doing other things. So the purpose, again, as we've talked quite a bit about, is to have a more dynamic, more opportunistic, and have tools available to the manager that cost a little bit more. It does cost a little bit more, but over time it's intended really to reduce volatility while providing participation in up markets. And I think it's done its job. Certainly over the last 10 years, fees have come down. There has been some ability to push the cost of this kind of exposure down somewhat. Transparency, I know many of you weren't on the board at the time, but the level of transparency and information available coming from hedge fund managers has dramatically improved, primarily because of institutional investors getting involved in the market. So that's been a good thing. So again, just wanted to tie into Dan's comments since he was here and looking at that part of your allocation. Overall, as we look at the total portfolio allocation, roughly in line with targets, still a little bit overweight to fixed income, as we mentioned, and that's because the real estate isn't fully implemented yet. You're still about 2% underweight to real estate, and I'll talk a little bit about that this morning. Just turning to the portfolio on the second page. I don't know if the ASAP, if our monthly report looked like this, I think we did. So the second page is just looking at the asset class level, rolling over the asset class up. Large cap, you can see for the quarter, which is the 3 months, slightly positive, trailing the benchmark a little bit. On a one-year basis, up 19% still. So even with a bad September and a bad July, you still have positive 19% from U.S. equities, which is the best performing asset class, U.S. stocks over the last year. Small cap, U.S. large cap stocks. Small cap stocks have really sold off quite a bit as risk. You've seen much more of a flight to quality. Small cap down 4% in the month, and 4%, a little over 4% for the month and 4% for the quarter. On a one-year basis, up almost 11.5%. And your small cap manager is doing a good job outperforming the index, and there you have much more active management versus the more passive and enhanced index in large cap. And you're getting contributions from both the value and the growth in small cap. Long short equity, Dan gave the update there, but about half the return of the long-only markets, particularly large cap, with a third of the risk over that one-year period. Private equity, and I'm going to talk a little bit more about your private equity program. We've actually started to see some distributions back to you and some decent markups, at least, in the portfolio. And the one-year return for private equity in what we would still consider to be a fairly immature private equity program, up 16%, so very additive to the overall portfolio on a one-year basis. International equity on a relative basis has actually done okay. Here, Lazard and Harding Loevner, as markets have turned around and quality is now more in favor, those managers doing pretty good. And this has been an area that has been fairly difficult, was a little bit more difficult latter part of 2013 for active managers to keep up because of the monetary policy in Europe by the European Central Bank providing a lot of liquidity to the markets, lower quality companies, that peripheral European countries doing much better. Now you're starting to see that turn around, and what a lot of these managers were saying is, the fundamentals don't look good, and I think you're seeing that being borne out now. Certainly markets are down, but the higher quality managers looking a little bit better. Really seeing that in emerging markets. While certainly don't like negative returns, Von Tobel, if we look back probably 6 months ago, Von Tobel was 99th percentile. When emerging markets started to make its comeback, they weren't keeping up. But now you see markets selling off, and they're doing pretty well. They're up. They're down about half as much as the benchmark, and now over a year to date, they're up 7, and the benchmark is up to 2.7. I don't know if, for those of you that were at the conference and heard Peter Newell, he does a very good job, and the message is very consistent about what it is they're trying to do, focusing on a growing middle class in emerging market countries, and over time capturing the growing earnings in those countries. Your fixed income portfolio up 5.5% on a one-year basis, much of that coming from the global bond and the core plus. More recently, it's the reason why we have the core portfolio, or the passive core portfolio, one, for liquidity, but two, for periods like right now, where you're seeing yields continuing to come down. 10-year Treasury yields have come down even further, down to about 2.36% earlier this week. That's pushing up Treasury prices and that flight to quality, so you're participating there. As I mentioned, the commodities was funded at the end of September, so you see that number in here. A lot of these numbers are preliminary because this meeting is so early and we're missing a couple of benchmarks because the hedge fund benchmarks weren't available yet, but some of these numbers are still preliminary. So no manager issues at this time. Fortunately, at the conference, that the news that Friday morning at the conference was certainly there was a hum going on. Have you heard about Bill Gross? Have you heard this happening? Fortunately, you all were not invested in PIMCO, as many other plans in the state were not either. Not that PIMCO is certainly a very good manager, has been for a long time, but that's certainly created a lot of buzz in the market, and you're seeing a lot of flows moving. One of the things we've seen is a proliferation of active bond managers getting out and pushing their strategy. We would anticipate Western being a fairly good beneficiary of this, of the flows coming out of PIMCO. The other item I had this morning was an update on the private equity and real estate portfolio. We try to do this twice a year, just to do a little bit more detailed update. Generally, we want to coincide it with recommendations. I don't have any specific recommendations today, but there are a few that will be coming down the pipeline over the next few months. So just by way of background, if you would, I'll turn to, I'm going to skip over tab 1 and just go right to tab 2, looking at your private equity portfolio. So I mentioned you have a fairly immature private equity program at this time. And what I mean by that, within private equity and the private real estate strategies, the way you implement it is by making commitments to provide funds to provide capital to funds that are going to invest that money in portfolios and companies over a period of time. After they've invested, they'll improve the company, make improvements to the company or to the property if it's real estate, and after a 5 to 7 year holding period, they sell that company or property and distribute funds back to you. You're still in the fairly early stages of the development of that program. So what page 13 shows, the three different components: current value, invested capital, and distributions received. The one thing we're not showing on here is commitments, which is the thing you actually control. So your committed amount is actually a little bit more than this. You've committed to 3 private equity partnerships, 2 fund-to-funds, and 1 direct portfolio, and that's a total of $32.5 million as of now. So you've committed $20 million to Mesero, which is a private equity fund-to-funds in 2009. They've drawn down a little over half of that, meaning they've invested $11 million. You still have $9 million left to fund into those companies. Singular Guff Distressed Opportunities Fund, that is again a fund-to-funds that's investing in distressed companies, was really taking advantage of the aftermath of 2008. Much of it is credit-oriented, investing in the fixed income securities of private companies. That was a $5 million commitment. That's essentially fully drawn. $4.7 million has been invested. You've actually received $4 million back from that fund. So and that's what you're seeing in the dark blue on page 13, those distributions. The current value is the light blue line. So what you're seeing is now the current value, you can see there has been appreciation over and above what you've put in the ground, the invested capital, but still fairly early on in the program. So the next page, we've touched on that. Some performance there. The net internal rate of return on this portfolio at this point since inception is 11.5%. Essentially what we're looking for over time, it's difficult to measure success early on in private equity portfolios. You really can't tell the score until the end of the game. But over time, over a 7 to 10 year period, we'd expect 200 to 300 basis points above public markets for the illiquidity that you're taking on in private markets. And we think the way the portfolio is developing is certainly good. And so as we look at performance versus public markets on page 15, you've really started, the inception of your portfolio was at the bottom of the market when public markets were beginning to take off. It's actually a good thing because you're putting money to work at good price, at low prices. You're just not, the companies are still immature and you haven't received realizations or they haven't been sold into the market yet. So that's not a concern at this point. The real focus of this is really on what we can control, and that's the commitment pace. So this is what we try to review twice a year. Unlike your public equities and liquid fixed income investments, you don't have the ability to rebalance. You don't have the ability to say, okay, well, this is overvalued or undervalued, let's put more money in. The one thing that you do control, or take money out, the one thing you control is the pace of commitments, making new decisions to fund new partnerships. And we have to be thoughtful about that. So the target is 5% of the overall portfolio. And I think we were cautious with 5% in terms of asset allocation as opposed to saying 10, which certainly is a more meaningful allocation because we recognize that it takes time. It's going to take, you're already 5 years into this and we're at about 3%. So it takes 7 to 10 years to get up to somewhat meaningful allocation of your portfolio. So what we do, we have this cash flow model that we utilize to try to isolate how much money a given investor should be committing on an annual basis. On page 16, the blue line in that middle of the page, projected private equity portfolio rate. As of 8/31, you're at about 3% currently in private equity. What we're doing here is making some assumptions about new commitments. So in 2015, we're showing 20 million or 10 million of new commitments. 2016, 7.5 million. 2017, 5 million. These are just our inputs into the model to give us a sense of how much do we really need to put to work over time on average. The years, it's better to think of those, while we're showing them in calendar years, it's better to think of those in terms of the next 12 months, the next 24 months, not necessarily a calendar year period. So what this tells us is that with a commitment pace of about 8 million a year on average, which is in the upper right, you'll get to 4.8%, 5% in 3 years. And we stress test that because what we don't want to happen is if we put in bigger numbers, if we say, well, what if there's really good opportunities and we committed 20 million a year, 15 million a year. What we see happening is that private equity weight could go up well above that 5%, which is not intended. And you get into situations like many investors had in 2008 or 2001, where if the equity markets sell off, you're still putting money to work in private equity. You made big commitments when things were good. You haven't funded them yet, and then things go bad, and now private equity is, instead of 5%, it's 10% of your portfolio, which we didn't intend, and you have less liquidity. Because it's such a small allocation today, that's not a huge risk, but we're coming down on about an $8 million commitment pace per year, which is about what we've done. We made a bigger one, the $20 million commitment to Mesirow. Remember, that's a fund of funds that's going to be spread out over time. So then the next thing we look at is just at the current portfolio, what should we be looking at? And we've kind of, you want to divide up your private equity allocation across the business cycle, if you will. And then we've added energy because energy is certainly a theme, the renaissance of energy in the U.S. It's such a booming business, as you well know here, but the opportunities there we think are pretty dramatic, and a lot of that is going to be captured in the private equity market. So having some exposure to energy in your private equity portfolio we think is appropriate. But currently, if we think about the business life cycle from early stage venture to later stage buyout, management buyout, growth capital, the Mesereau fund of funds is a very broadly diversified, covering a number of different funds. Warburg Pincus, that is a global private equity fund. It's a single manager just investing in companies, one of the largest managers in the world. They're investing from early stage, seed stage venture to later stage buyout and takeover type strategies. And then the Singular Guff was a unique opportunity coming out of 2008, where you're at the bottom of a cycle to take advantage of distress, and it's very broadly diversified, more in the credit area. So things just coming down the pipeline. As I mentioned, we don't have any specific recommendations today, but if you turn to page 18 and 19, there's a couple of funds, individual direct funds, much like a Warburg Pincus, which we think would be good opportunities for you all. We're in the early stages of our due diligence with these managers. They haven't even come to market yet, or they're coming to market now, but they haven't had any closes. One is ArcLight Partners, which is a diversified energy strategy. We think that might make some sense. We won't go into detail about it. This is further down the line. And then Oaktree. Oaktree is one of the largest, most successful distressed managers, individual managers. They're coming to market later this year, raising a $3 billion fund, which will have a secondary kind of tag-along opportunity that they expect. What that means is they'll raise $3 billion in early 2015, so they have capital to put to work. Investors that come into that fund will also have the ability to add to that investment for what they believe will be an even bigger opportunity in distressed, to take advantage of a lot of the corporate financings that went on in 2009 and 10 that are going to need to be refinanced probably in 2016, 2017. So we think that's certainly an attractive opportunity. But again, just wanted to give an update on where we were and what we're thinking. This is a part of your portfolio that really the construction of it doesn't stop. We need to continue building this, because as these partnerships mature, you start to get money back. You're seeing that money is coming back, and so if you stop, the value will just come down. We need to get it to get up to 5% and stay there. Final thing, just a quick update and reminder on the real estate portfolio. You have a 5% target allocate, or no, actually 6% target allocation to core real estate, which is the Morgan Stanley Prime Property Fund. Core real estate is high quality, diversified commercial real estate, multifamily, office, industrial portfolio. Multifamily, office, industrial, and retail are the four broad categories. These are generally fully leased, where 90% of the returns are coming from the income, coming from rent as opposed to price appreciation. As you move out a little bit further on the risk curve into value add and opportunistic, you're taking on maybe a little bit more development or lease up risk. For that, generally the vehicles that you invest in are less liquid. They're more private equity type vehicles, longer lockups. You would expect a little bit higher return. You have a component of that with TA. It's a small piece. You've made a commitment to their last fund, and that was in the amount of $5 million. That they've drawn that's almost fully drawn. They've drawn $4.25 million, so there's about another $750,000. They will be coming back to market with another fund to put to work over the next 4 to 5 years, early in 2015. So we think that's something that we would want to take advantage of, presuming everything makes sense with that new offering, as well as potentially something a little bit further out on the opportunistic side, as you've got a little bit of space left, that 2.5% that's unfunded or underallocated to the opportunistic real estate. So that's an area there. What we're ultimately trying to do is we're trying to have a fairly diversified both private equity and opportunistic real estate portfolio without making 20, 30 commitments, but having pretty targeted commitments to some really high-quality managers that we expect to be around for a while and to continue making commitments to them, presuming that the underwriting of each successive fund is positive. So again, no recommendations at this time, just wanted to give you an update on where we are and what we're thinking and what's coming down the pipeline. I would anticipate that some of these opportunities are going to be, have come to fruition probably the later part of this year or the first of next year.
Any board members have any questions? Go right ahead, sir.
I was just curious on the distributions from the private equity. Are they at the point where they're actually going to be able to grow that allocation towards the target?
Well, that's the point. It doesn't grow toward the target, because when they make realizations, they're distributing that money back to you.
Right.
So you have to make new commitments.
So there's no reinvestment options with the distributions then in those?
No, you can't reinvest in that same fund.
Okay.
It's not recycled.
Okay.
They then come, so what happens, so like a TA, as that fund is maturing and they're going to run out of capital to invest. So they need to come back and raise another fund. So they'll raise another fund, they'll go out to limited partners and say, okay, we're going to raise another fund to invest over the next 4 years. And if investors say, yep, still like the people, like the approach, the process, make new commitments, they'll invest that over the next 4 years. While the older funds are maturing and they're sending that capital back to investors, hopefully, I mean, it doesn't match up dollar for dollar, but as distributions are coming back, you're reinvesting in new strategies.
Jason, just for understanding, if we increase our percentage at any time in the future on private equity, it would take 7 to 10 years before that money would actually be working?
What I was referring to, if you go from zero, I mean, our experience is to go to from 0% in private equity up to, let's say, 5%. It takes time to get there, 5 to 7 years. As you see, we're not there yet. You started in 2009, so we're 5 years into it, and you're at 3%. Now, some may say, well, you could be more aggressive in your commitments, but the risk you run there is there's a market correction, then you're way overcommitted. If you had a 10% allocation, which where I was going with that was realistically from an asset allocation standpoint and from an impact standpoint, I think over time we probably want to revisit this and move that allocation up to 10% in private equity to have a bigger, more meaningful impact. But it's going to take time to get there. The reason why we didn't do that is because we know we could say 10%, and if we model that, it's going to show good returns from a modeling standpoint, but it's not realistic to get there that quickly.
Any other questions? If not, thank you, sir.
Thank you.
Oh, yes, go
Just
ahead.
congratulations for those of you who don't know. You guys are the hosts of the conference, the Public Funds Conference next year.
You let the cat out of the bag. You know
I'm
that?
sorry. We're here to help with whatever we can do
Okay.
to make that.
Item 12, comments from board members, staff. Only thing I have is Jason let the cat out of the bag. We are going to sponsor it next year. It looks like it's the 23rd, 24th, and 25th of September. And OU has a home game with Tulsa on Saturday the 26th. So it looks like we're going to use the, what's it called, NEDC? Is that? Yeah. It's what? Well, it's the old Postal Center, and it's the hotel's run by the Marriott. It's a nice facility. They've got a lot of stuff there. It's unbelievable. I didn't know. That's the first time I'd ever been there. I didn't realize the campus was so big and had so much to do. But anyway, so we'll do that. So that'll take some time later on next year. We'll have to be putting some time and effort in to help Jason and Renee get stuff done. Other than that, that's all I have. Anybody else got anything?
Yes, Mr. Chair, I just wanted to mention I had Renee send me, I guess a few weeks ago, our strategic business plan, and it has not been updated in several years. Do you remember the last time it was updated, Renee?
It was 2009 or 10.
So I think it's probably time that we take a look at it. I'm not sure that there are going to be significant changes to it, but I do think that at some point we probably need to take a look at it to make sure.
Okay. Not a problem, we can look at it. Yes, sir?
Thanks, everyone, for meeting on another day.
Yeah. We just hope we bring a victory back, right? Okay. Anything else? If not, we're adjourned at 11:05. Thank you.